Imagine retiring early with little to no tax burden, only to wake up years later facing a 32% tax rate on your hard-earned savings. It happens more than you think. We call it the good saver tax problem. The good news is, with proactive planning, you can avoid this tax shock and keep more of your wealth.
Hello and welcome to the Relax, It's Retirement podcast with your host, Josh Leonard, where we talk about transitioning into retirement with intent. I'm Wendy McConnell. Well, hey there, Josh. How you doing today?
Wonderful. How are you today, Wendy?
I'm good. We'll pretend like we haven't had a nightmare of tech issues.
We can jump into that, Wendy. Sometimes we are with our best intent, right? We get upgraded equipment and it doesn't work correctly, or I don't know, but we're on. So with best intent, sometimes we don't get the result that we want, but we're able to adapt too.
Well, my intent is to be here for the entire recording. Let's see how that goes.
We're gonna do it. I'm optimistic here.
All right, here we go.
I think it ties well into our topic today, though. It's the good saver tax problem, right? You did the right thing, right? You saved money for retirement. Many folks that we see that have the GSTP, or the good saver tax problem, are ones that saved a lot, and we're able to retire early. So that's all good news. The bad news is, without proactive planning, although they were a good saver and did all the right things, they might be surprised later on in retirement to be hit by higher taxes.
Okay, so how do we prepare for that?
Yeah, so I think we'll use Sue here. Sue as an example. Sue worked really hard and was able to retire at age 62. She was fortunate enough that she had enough in retirement savings. She felt comfortable walking away from the workforce. And the funny part is she was able to save a lot because she was very frugal. So now she decided, hey, Social Security is enough for my income. So she started that income source. And then at age 65, 3 years down the line, her pension starts, which is going to bump her up into a 22% tax bracket. And then all that savings she put away in her 401k starts to be forced out of her account at age 73 when she's forced to take her required minimum distributions. So in Sue's case here, this is like the stereotypical good saver, is she goes from a 0% tax bracket, because when she only has that Social Security income, none of it's taxed. Then her pension comes into play. She bumps up to a 22. And then with RMDs starting at age 73, she bumps up to a 32% tax bracket. Looking at that, you think, oh, good, I saved money, right? That's the right thing to do. And I'm in a low tax bracket now. I'm doing great in retirement. What we want to avoid, though, is paying almost a third on every dollar for our taxes in the future. No one wants to pay a third in taxes, right? We want to make sure that we're getting the most out of our hard-earned savings, and sometimes these phases of retirement stack up to us. In Sue's case, we would say it's an early retirement. That's phase one. Phase two is income stacking begins. So in her case, it's that this pension is added in. Well, it's wonderful to have a pension, Wendy, right? Well, I'll take one. If anyone's giving them out, I'll take two.
Yes, please.
But by her, it sort of defaults her up into a higher tax bracket. Mm-hmm. From there, her RMDs, because she saved a lot in her retirement plans, are going to be another stacking shock here once she reaches age 73, which we would consider phase three there. So if we look at it, she kind of has this stacking income bracket over time. It's going drastically higher. Assuming her IRA or 401k accounts continue to grow over time, this problem might only become worse. And if she's used to only living off of her minimal income from only Social Security, she doesn't even need the money, right? It's a forced distribution causing higher income. So we want to be careful. When we see that 0% tax bracket in retirement, it might be a sign that we're not actually doing something right.
Okay.
What do you think, Wendy? Do you want a 0% tax rate?
Well, yeah.
Yeah, I'll take two, right? It's just like the pension, right?
Yes.
We think that it's a good thing because no one wants to pay taxes or additional taxes, right?
Right. That is always the best case scenario, but very rarely what happens.
Yeah, I mean, we want to do what's right. We're not talking about doing anything wrong, but 0% tax bracket can happen often. It can be from Social Security income or living off of savings early in retirement. For many folks, they'll retire and live off of savings to keep income low enough to qualify for health care subsidies through, in the state of Pennsylvania, through Penny, but in general, we'll call it Obamacare. The health exchanges provide more affordable health care to lower income individuals. It's income-based, not asset-based. So in an early retirement, prior to going on to Medicare at age 65, if income's low enough, we can qualify for those. Well, we need to balance our interests, because if we're going to get kicked up to that higher tax rate, it might make sense to pay for health insurance at full cost now, so we don't have to give a third of our income away in the future. By looking at our tax plan over our whole retirement, we're able to, hopefully minimize some of that. For many folks, they'll see stacking effects on taxes as well. So one example we often run through is John and Jane. They are married filing joint, and in this case, they're 65 years old. They're fortunate enough that since they both worked, they have about $70,000 coming in from Social Security. They need a little bit more, so they take about $60,000 out of their IRAs, and they also have $10,000 in capital gains. Well, there we're looking at kind of three different tax pieces stacking together. The Social Security income by itself is not taxable. The $10,000 of capital gains by itself isn't taxable. But when we add those in, plus the IRA withdrawals, we're hitting a sort of tax windfall point where if we were to take out another $1,000, it's actually taxed at 49.95%.
Oh.
And if you look at tax brackets, because I know that's what people do in their free time, Wendy, they look at tax brackets, analyze it, like March Madness is coming up, same thing, right?
Oh, yeah.
Tax brackets, basketball brackets, we're into the same thing.
No.
You might look at that income scenario. Wendy's like, no, don't even go there. Taxes are not that fun, Josh. You might look at the tax brackets and say, wait, I think they're falling in a 12% tax bracket. Well, that's correct, but it's a compounding effect because it's bringing their Social Security in to be taxable. So in their case, an additional $1,000 from the IRA would cause an additional $850 of Social Security to be taxable at 12%, so that's $102 extra, plus it causes $1,850 of the capital gains to be taxable, adding on another $277.50. So as we stack up there, we're actually paying $499.50 on a $1,000 withdrawal from the IRA. So let's avoid that.
Yes.
I think many folks are shocked with that. They, figure, hey, it's the end of the year. Maybe I want to buy grandkids some nice gifts, put money into their 529s, right, Wendy?
Yes, you are a big proponent of that.
How about the grandkids? Education's expensive. But if you're doing that, we need to watch those tax implications. In this case, that is sort of one of the worst areas in our stacking tax codes. By being proactive, we can kind of look down the line and say, hey, is this coming? If that's the case, maybe we wait and make those contributions January 1st the next year. So we're not hitting those high points in the tax code.
All right. So we have to plan ahead is what you're saying.
We absolutely do. I think too many times we have folks come into our office that get, a letter stating, hey, you owe more in taxes or your health insurance, whether it's through the health exchanges like we talked about in early retirement, or an IRMA letter later on in retirement, which is an increase in your Medicare cost. We need to be careful of those. Those might creep up on us. Many times those are the reason that people seek help. But by being proactive, if we can avoid those issues to begin with, that would be great. One of the ways we do that is what we call an incremental tax strategy. So spreading out income over time over your whole retirement instead of for the individual year. In Sue's case that we had talked about, she is not needing more income at this time and in that 0% tax bracket, so why would I take out money and pay taxes on it? Well, if we can relieve the pressure down the line, that would be a reason to do it. Now, Wendy, if you're Sue, you're probably going to say, okay, Josh, that all sounds great, except I'm not spending any more money. because I don't need it, right?
Right.
We don't have to spend it. We can utilize strategies like Roth conversions or even gifting strategies if we want to pass money on to the next generation. I think it's more important to set that budget of, hey, this is how much tax we should be paying to relieve the pressure in the long term. And then the secondary choice is what to do with it from there. Throughout the year, we should be setting a budget of how much we're taking out of our qualified accounts, in this case, to help relieve that tax strategy or that tax impact in the future.
Right.
Another important one, in the example that we walked through with the stacking income, they have capital gains as well. If we're not using that capital gains for income, let's try to minimize that. So we could utilize some tax harvesting to try to lower those. Or if we have a lot of gains in the portfolio, make that part of our tax plan for the year, that we're realizing those incrementally over time so we don't get a surprise in the future.
All right. So let's be strategic about it.
Yeah, and this is the time of the year because everyone now, you go to file taxes and then, you figure out you owe or all the problems that, it's too late to fix at this point. So by being proactive, by planning ahead, looking at these things at this point in the year instead of after the year ended, we could take some actions here to help relieve that pressure. I had mentioned briefly, but Hurricane Irma is a big one that upsets retirees. This is when your income drives the cost of your Medicare higher. So the lowest tier of Medicare cost is $106,000 or less for those filing individually. So if you have under $106,000 in modified adjusted gross income in retirement, you pay $185 for Part B. If you blow out the tax brackets, you have a great year, Wendy, and your income's over $500,000, you pay almost 2.5 times the cost, or $6,356.40 extra.
I don't like that.
That causes your Part B and Part D, your drug plan, to go higher. We want to avoid that, and many times, you might say, well, $500,000, okay, pity on you, right? Go ahead, pay $6,000 extra. But that could be accidentally done by doing a large Roth conversion or something like that, where we try to help relieve our future tax problems, but kind of hurt ourselves in the short term by taking too much out. So we need to watch that. Many times that comes as a surprise to folks. They'll get the letter saying, you're going to pay extra money in Medicare in the future. This looks 2 years back. So right now you'd be receiving a letter for 2023. So you might not realize it in the year that it happens, but you'll definitely be excited about it whenever you get that letter. So again, we need to be proactive there, looking down the line to avoid that, rather than just reacting once we get that information in.
Okay.
So you got it all, Wendy? You got taxes minimized throughout retirement?
Yeah, but what if I didn't look down the line? What if I'm stuck now? Is there some things that I can do to minimize it at least?
So I think you need to start making actions now. If we are already at that RMD stage, so let's say we're 73 now and we're forced to take those distributions currently, you might say, okay, well, this is great. I wish we would have had this conversation 10 years ago, Josh. What can I do today? There are some things that you can still do. Part of those RMDs can go to charity. That creates a non-taxable event. So if you regularly contribute to the church or the local animal shelter, the local food shelter, if we take that distribution from our IRA and send it direct to the charity, that's a non-taxable event, and it still counts towards our RMD.
What if I want to keep my money? What if I need it? You're doing this scenario of, we're being forced to take this out because, it's just your age and
Sure.
you need. But what if I actually am relying on that money? Is there a way to minimize the tax effect if I'm using that money?
So if you're currently using it, this is kind of fourth quarter, right? It's a little hard to adapt there. We need a tax deduction at that time. Like we talked about charitable giving via the QCD. If if you
Yep.
remember that,
Right back
right?
there.
So
Yep.
put the official label on it there, but that would be a little late. If we need all that money that's coming from our RMD, we're gonna have to pay taxes on it. If again we look at being proactive and say, hey, with the income needs I need in retirement, I don't really like the tax bracket I'm gonna be in. We could start strategically planning now while you're still accumulating, Wendy, while you're still working, put a little more into Roth or lower taxed funds rather than having the default of all of our IRA or 401k funds.
So the best case scenario then is I need to talk to you to
Yes,
figure out what I
avoid
need to
avoid
do.
all problems, Wendy.
They're easy peasy.
Yeah, I think proactive planning is always helpful. We call this the good saver tax problem because it is people that had really, really good planning in saving. They took a large chunk of their income, typically lived below their income means, right? They could have, drove a fancier car or whatever it might be, but they opted not to do that and they saved more and more. And now by default, they're kind of getting pushed up into a worse tax scenario. So
Yeah.
we really want to be proactive with that as much as we can. During our working years, we're many times not thinking that strategically because we're going to work, right, to pay the bills, and we're kind of on this cycle. So especially if you're retiring early, it's a great time to jump on this problem now and start relieving that pressure down in the future. We also have tax uncertainty, right? This year, our current tax cuts are up for renewal. Not a betting man, but I do think based on the actions of the government, we are trying to justify that we've reduced costs enough to extend tax cuts. That would be my guess. But we are still a nation highly in debt, and we collect revenue based on taxes. So in the long term, I would be cautious if all of our funds are in an IRA or 401k, it's all going to be taxed when we take it out. If tax brackets go higher in the future, we might not have any tax flexibility.
Okay.
Yeah, so Wendy, I think moral of the story, lesson for today is let's try to avoid this good saver tax problem. We'll still save the money, right? We'll still do the good part.
Right.
But let's avoid the negative side of getting pushed up into higher tax brackets accidentally. We need to watch out for IRMA, Social Security, stacking up our income to cause, in the worst case, that 49, almost 50% taxation rate. So we need to make sure we're utilizing incremental tax strategies along the way to smooth out our tax curve. For listeners, I encourage you very, very much to take a look at your tax picture, start developing that tax plan for retirement as well. That's a key way to avoid some of these pitfalls we discussed today. In the show notes, we'll have a link for a 15-minute call. If you want to do a 15-minute call, see if we can help out with some of your tax problems. We'd love to spend that time with you and see if we can help relieve some of the pressure there. Our Pittsburgh chapter of AFEA, the nonprofit that we've been teaching classes through this year, has a chapter website at myafea.org/chapters/5039. That'll be linked in the show notes as well. You can register for upcoming classes. This year, we're hosting a lot of tax classes as well as Social Security classes. So if you're concerned about taxes in retirement, feel free to come to that class if you're in the Pittsburgh area. If not, you can take a trip. Pittsburgh's beautiful this time of the year. Wink, wink.
Cold, but beautiful.
It's cold. But, taxes, right? It's worth it. So we encourage you to join a class, learn a little bit more. By educating yourself and being proactive, you can make the best of your retirement. Wendy, thanks for joining today. Listeners, thanks for listening in. And until next time, remember to retire with intent so you can live your golden years with the happiness and excitement you deserve.